This is Kyle with Fundamentals of Finance, back with another video where I expose the lies and misinformation spread on popular so-called investing channels to help you decipher between fake news finance and fundamentals of finance. Today I'll be taking down Jeremy Schneider of Personal Finance Club, which is a channel that has over 400,000 followers on Instagram. If you haven't seen them, I've already shown you the lies and misinformation of 3 other investing YouTubers. The first was Reventure Consulting, a scaremonger who has no idea what he's talking about. Then there was Nick Page Investing, who knows less about investing than my kitchen table. And lastly, there was Investing with Rose, who means well, but lets her bias creep into her videos and just isn't knowledgeable enough to really teach you how to invest. Personal Finance Club is most similar to Rose. His advice is generally good. Live well below your means and invest. And I think he means well, but this video is a good example of how you have to think twice about who you listen to. Is it fake news finance or fundamentals of finance? He seems credible from the get-go. It says he retired at 36. That's pretty impressive, and he provides daily investing tips. So he must have retired by being such a successful investor, right? No, he sold a tech company. So what does he know about investing? Probably not much more than the average person. On his website, he says he gives unbiased information. Well, let's see about that.
Those mutual fund managers charge a high fee for their service, and study after study show they overwhelmingly lose to the market after accounting for their fees. So enter the almighty index fund.
Okay, so he's trying to make the case that active managers trail their index and passive index funds are better. So surely if he's going to tell you to buy index funds, which track an index, he must know what an index is, right? No, he has an average person knowledge of what an index is, not expert knowledge. And in this case, he's wrong. Let's take a look.
For example, the S&P 500 is an index of the 500 biggest companies in the US.
No, it's not. The S&P 500 is not just the biggest companies in the US. It's a list of companies meant to be representative of the US economy. But don't just take my word for it. This comes from S&P Dow Jones themselves.
In my opinion, buying and holding index funds is the most effective and efficient way to build wealth.
Well, we're all entitled to our opinions, but I think we've established this is not an expert opinion. I wonder what unbiased information he has to support this claim.
Let's take a look at how this looks in real life. If we Google this ticker symbol, we can find the Morningstar page for this mutual fund that has tons of information about it. We can see that it has a load of 1%, that's a fee you pay when you buy it, and an expense ratio of 2%. That's a fee you pay every year you hold it. If we scroll down and look at the chart of the performance, the blue line is this mutual fund, and the red line is the index it's trying to beat. You can see it's getting crushed by the index.
Okay, this is extreme bias and stupidity all rolled into one. Let's rewind and go piece by piece.
We can see that it has a load of 1%, that's a fee you pay when you buy it.
Actually, no. That's how A share loads work. With C shares, which the one he's showing you here is a C share, you only pay the load if you sell it less than 1 year after you bought it. But the fact that he doesn't even know how C shares work is not even the worst part about this. That's just him pretending to be an expert when he doesn't really know what he's talking about. The worst part is how he deliberately tries to mislead you. He does this in 2 ways. First, he picked one single random fund without telling you how he selected it. And he's making it out like this is representative of all actively managed mutual funds. Why do you think he chose this particular fund? Well, that fund was actually so crappy that it doesn't even exist anymore. Wells Fargo merged it with another fund in 2021. And actually, Wells Fargo was so crappy at managing mutual funds in general, they don't even want to be in that business anymore. They sold it to a private equity firm in 2021, and it's now called Allspring Funds. The second way he deliberately tries to mislead you is by picking C shares, which are an antiquated share class that no one should ever buy anymore. Why did he pick C shares? Because they're the most expensive share class by far, and he's trying to make active management look bad. This is like taking a bench warmer on a community college football team and saying, see, based on this guy, no one from college can make it to the NFL. It kills me that 400,000 people are listening to this guy. We already know he doesn't really know what an index is, but let's see what he compares this fund to.
This is a total US stock market index fund.
Which share class did he choose for the index fund? The Admiral shares, of course, the cheapest ones that most individual investors can buy with a $3,000 purchase minimum. Does this sound unbiased to you? It doesn't to me. It sounds like fake news finance. If you want to learn the fundamentals of finance from someone who is actually unbiased and can teach you how to invest like a professional, hit that subscribe button and let the transformation begin. Also, check out the link below called the 9 Habits You Need to Be a Successful Investor. If you have any questions, let me know and I will see you in the next video.